Hello students, so welcome to this particular special class, a special session on the special tax rates of the companies. Students, in this particular lecture our focus would be on the MAT concept. First, primarily we are going to look upon the basic tax rates which are applicable to a domestic company, also to the foreign company, and thereafter we will switch towards the discussion on the minimum alternate tax. So there would be like 2 videos or so on the theoretical aspect of the MAT provision. So all the basic provisions which are there relating to the MAT, I'll try to cover it up in this particular video, and in the next particular video I'll try to do with you the most advanced theoretical part on the MAT, which has to do with the Ind AS provision, as well as, students, the next particular part happens to be after Ind AS. Students, it is about the REIT, the writ as a concept. And this thereafter would be followed up with practical case study, students. We will be solving the practical case studies, and that will give the closure to one of the most important topic for the upcoming May 21 and the November 21 attempt. Now students, this particular the PDF file of which I will ensure that, since I will be putting it in the YouTube, so I'll be putting up in the description box the link of the PDF would be there. Let's start with this important concept of the special rate of tax, students. You all are aware of the general rate of tax which is applicable for a domestic company as well as to the foreign company. Also, you may be aware of the fact that there are some differential, the surcharge rate applicable. Whether it is a domestic company, then the rate is different when the total income is more than rupees 1 crore and 10 crores, when you compare this same threshold of 1 crores and 10 crores of the foreign company. The surcharge rate in both the cases, are different. So students, herein we will look into that particular part. Now there is one very important concept, students, and that is this: the normal tax rate that we all know is 30%. That is what is generally understood by the students. However, students, here there is one more normal tax rate of a domestic company, which is actually an SME company. What is the full form of SME? Perfect. The small and the medium enterprises. So for an SME company, students, the base rate, students, is 25%. First of all, you may be wondering, sir, how do we know that a particular domestic company is an SME or not? So this is what is the criteria. Please pay attention. So current year, students, say for example, the current year for you is 2021, your previous year. So for the previous year 2021, you shall be considered as an SME, small and medium enterprise company, if for the previous year 18-19. So I'm talking about the current previous year 2021, you will be considered as an SME if for the previous year 18-19, your turnover, students, is what? Is not exceeding 400 crores. So if your turnover for the previous year 18-19 doesn't exceed 400 crores, then in the current previous year, which is previous year 2021, you will be considered as an SME company. Somebody will wonder, sir, why is it that there is a gap of 1 year in between? Like ideally it should be like this, that for previous year 2021, which should fall to the last previous year, which is 1920. So why is it that we are considering the previous year 2020 to decide? Why is it that we are considering the previous year 18-19 turnover to decide whether we will be considered as an SME for the previous year 2021? What is the correlation between the two? So students, the correlation is this, that why this 1 year gap? students, you may be aware that there is 1 year gestation period. Like, what happens? You will file the return in the assessment year, and then it will go for the intimation. So there can be some apparent mistake that will get rectified, isn't it? So that will have an impact on your turnover. So all this will take a due process of at least that 1 year gap, therefore is necessary to finally establish that yes, for previous year 2021 you could be considered as an SME based on your turnover performance of the previous year 18-19. So that way you will decide whether you could be considered as an SME for the previous year 2021 or not. One question that arises, students, is this: that supposingly I am a company which has been incorporated, say in the current year itself. In the current year itself, I have been incorporated. So you can say current year means 2021. So I have been incorporated in current year 2021, or you may say that I have been incorporated in previous year. What is the previous year? Previous year is say 1920, last year. So if I have been incorporated in this particular previous year, so therefore again the question that may arise to your mind is that whether I could be considered as an SME. Please be careful. Your year of incorporation is either current year or the last year. So you don't have any turnover. You don't have any turnover for the previous year. Which previous year? 18-19. So in such particular case, whether you can still be considered as an SME for the previous year 2021 in this particular case study, to that the answer is no. Students, you can be a Reliance primarily. Who knows in this regard? You may be a Reliance in this scenario and you have just yourself incorporated it. We cannot consider you to be an SME primarily. So the SME requires the turnover threshold to be satisfied. So unless and until you satisfy that turnover threshold, we cannot know, and we don't know whether you could be considered to be an SME in the current previous year. In fact, what will happen, students, I'll tell you. In fact, that 1 year gap, it is not only for this particular previous year 2021. This has been always the case. It's different that you may have read it right now, but this situation has always there earlier also. Like in the last previous year, which was 1920, to become an SME for 1920, you were looking into the turnover of previous year 17-18. So that was the kind of 1 year gap which always existed. So this is one thing that you should always keep in mind. Secondly, students, in your question now, when the question comes in the examination, you have to be very careful about, when the question targets the computation of the tax liability from you, they expect you to calculate the tax liability, and if they give you any hint of the turnover, that for example the turnover is 390 lakhs. The turnover is 390 lakhs. So if they give you any hint of the turnover, then you have to know that they are talking about this particular aspect. So this is the aspect that they are targeting it, and accordingly you have to take a call and get your solution in order. So do it in this particular way, students. This is the most logical way to conclude in this particular context. Now, one point which is there about the surcharge. Now, students, as I was just telling you, and I will repeat it again, once you are in SME, your rate will be 25% instead of 30%. But your special rate of tax, students, the special rate of tax, which we all know, if in your total income you have any special income which is charged to a special rate of tax, then those special income will continue to be charged. Those special income will be continued to be charged at the special rate of tax. It is only what, students? It is only the balanced total income. It is only what? The balanced total income on whom the charge will be as per what? As per the 25% rate, provided you are an SME. And if you are not an SME, then as we all know, it is always at 30%. What about the surcharge? Surcharge doesn't change whether you are an SME or you are a non-SME. the threshold for the domestic company surcharge. We all know 7% or 12% as the case may be, depending upon whether the turnover exceed rupees 1 crore or the turnover exceed rupees 10 crores. So either one of the two should be there. Once the threshold crosses to this limit, we will say that yes, the surcharge would be applicable in this particular category. So students, just only factor which I have told you is that just be aware in the examination, you just be aware of this factor, that the moment they give you the turnover of 18-19, definitely they are signaling something about the tax rates. At the same time, if the question is anything to do with the current year of incorporation or the last year of incorporation, please don't assume that in the current year you will become an SME. Don't do that. These are some of the silly mistakes that you may end up doing it. Students, there is this 115 BAA. I have made a reference, but for this we are having a separate, we will be doing a separate lecture on this alternate tax regime at that point of time. Again, a very important topic for your upcoming May 21, November 21 attempt. We will discuss this thing very carefully. Why I am saying so, it is so important for May 21, November 21 attempt, because for May 21 and November 21 attempt, because students, this November 20 attempt, hardly there was any coverage on the same. MAT was asked, minimum alternate tax, but it was a very basic adjustment. The kind of the adjustment that we have in this material, like that is quite a bit advanced when it is compared with the question that was being targeted in this particular attempt. So I'll just put this discussion later on. 115 WBA, BAB, all these discussions, friends, I'll just do it a bit later. Let's do this particular question number 1. Although you can get this in the form of an MCQ. Let's still have a look to this particular question. So what it says, ABC Limited, an Indian company, ABC Limited, an Indian company, was registered on 1st of April 2015. So now, registered on 1st of April 2015, it is solely engaged in the manufacture of the textile. So that is one. Its turnover for the previous year 17-18, 18-19, 19-20, 20-21 are rupees 50, 350, 380, 450 respectively. What would be the total tax payable by ABC Limited for AY 21-22? If its total income for the previous year is how much? 9 crores. So total income, students, is for more than rupees 1 crore but less than 10 crores. So surcharge element would be there of 7%. But whether it is an SME in the previous year, 2021, for that we have to see the turnover of previous year 18-19, and previous year 18-19 the turnover happens to be 350 crores. Sorry, it is 350 crores, so definitely not exceeding 400 crores, and hence for previous year 2021 we can say that the company ABC Limited is an SME. 25% would be the normal rate of tax, and the surcharge total income has been mentioned, so in that very case I would be at 7%. Now what they are saying here, would the rate of tax for AY 21-22 in the case of ABC Limited be different if it was registered on 1st of April 2020 instead of 1st of April 2015? If yes, what are the conditions to be fulfilled to avail this one? Here, friends, we are ignoring this provision, but we have applied 115 BA, if I am not mistaken. See, there is one particular provision. Again, I don't want to touch upon this section right now, because these three sections, 115 BAA, BAB and BA, these three sections we will touch upon exclusively in an alternate tax regime for a company. A good analysis, students, is going to come wherein we are going to solve, even in that particular chapter, practical questions. Unless you solve the practical, students, direct tax to really, and not only the practicals, a lot of permutation combinations needs to be solved so as to really get a hold over the entire content. So that is one thing that we will look into it. I'm just skipping this 115 BAA and BAB for the time being. Any case, for that there is a dedicated session on it. Let's come towards the math part. Students, the math as a concept, all of you are aware exactly what was the basic philosophy of the math. In fact, students, in the AMT itself, I have already have, uh, or maybe you are aware that in the AMT also similar lines, the philosophy was there. The underlying difference happens to be that the AMT is for a non-corporate, whereas the MAT is for a company SSE. So that happened to be the fundamental difference between the two. So now, in this particular context, what is the rationale or the logic behind the MAT provision? So the logic behind the MAT provision, students, you have to go back to those late 70s. Students, what happened was that I'll tell you, the MAT was being introduced because of Reliance Industry was one of the main, you can say, the architect why we are doing MAT. See, students, Reliance always used the tax incentive as the basis to reduce their total income and eventually their tax liability. In fact, you may be aware many ATIA, ATIB provisions we have seen, and there are tax holiday. These are the tax holiday scheme. So Reliance used to avail all these tax incentive provisions, used to go in the tax holiday for 10 years period. So what used to happen, by taking a tax holiday, their entire profit used to be eligible for the purpose of the deduction, so that the total income was negligible, and eventually the tax liability also was a very negligible amount. Now, the moment the tax liability was a very negligible amount, that created, or that has put up the immense pressure on whom? On whom, students? On the shareholders. So the shareholders primarily came under not the shareholders, that put an immense pressure on the individual taxpayers. See, one thing has to be there. If the big companies like Reliance and all, if they don't make the payment of tax, ultimately the burden will shift on someone. The government has to recover the money. They have to collect the taxes. Somebody has to pay. Otherwise, who will be the one who will put the money in the treasury of the government? So someone has to pay. That is inevitable. So therefore, you are now picking up the individual taxpayer who are less able or capable as compared to whom, students? As compared to the company. Now the best part, students, used to be what? Reliance and such like-minded companies, by taking all these heavy tax incentives, they used to have a negligible amount of total income, used to pay a very nominal amount of tax, and these are the same company that used to distribute a huge amount of dividend to their shareholders. To their shareholders, they used to always keep them happy, distribute a huge amount of dividend, but when it comes to the government of India, absolutely nothing so far as the tax was concerned. So therefore, government thought that this cannot be the way the country can run. This cannot be the system of tax collection, wherein the burden is on the person who is not that able to bear the tax burden, and the person or the company who are able to absorb the tax burden, they are shirking from their responsibility. So this kind of a system or a model cannot be sustained, and therefore they introduced, students, what they have introduced? They have introduced the concept of the MAT. That, look, all that is fine. In the normal provision, your total income may be very less. You may make the total income very negligible. Tax liability again would be quite less. But minimum, you need to pay this much amount of tax. That alternate computation, we will create a separate chapter for it, on which the basis of computation of the tax base for this particular minimum alternate tax would be different when you will do it for the normal total income. Like, for example, in the normal total income, our tax base used to be the total income. That is what we used to calculate the total income, on which we used to apply the rate of tax. Whereas in the case of the MAT, the tax base over here, students, the tax base over here is not the total income but the book profit. So the base is different, so as to at least get what? Get a minimum alternate tax on this particular alternate scheme of taxation, and that was the objective. And this is precisely what got created in the form of the MAT provision. So students, let's have a look quickly. Applicable to whom? The company. Point number 2, including a foreign company having a permanent establishment or place of business in India. Which is, sir, why this P, permanent establishment or place of business in India, is the criteria for the purpose of the foreign company, getting applicable for MAT purpose. So students, herein the situation was like this. The situation, students, is like this over here. Students, in the Companies Act, you may be aware, in the Companies Act, there is a specific particular provision, which I think you may be aware of it, that the foreign company is required to maintain the books of accounts only if they have got a office or a establishment which is situated in India. So unless and until the office or the establishments are situated in India, that company is not required. That company is not required to maintain any of the unless and until there is an office which is there in India. The foreign company is not required to prepare or maintain its books in India. And if the books is not prepared, or there is no obligation to prepare or keep the books in India, then what will happen, students? That the net profit, which is actually, you will find, students, the net profit is the base for the computation of the book profit. The net profit as per the Companies Act is the base for the computation of the book profit. So that net profit will be computed only when the financial statements are prepared. The financial statements will be prepared only when there is a requirement towards the maintenance of the books of accounts. And therefore, if there is no PE of the foreign company, therefore the foreign company will not be obligated or will not be required to have will not have MAT applicable to itself. So students, point number 1, applicable to the company. Point number 2, including the foreign company having the PE or the place of business in India. And the third one, the company which is being a unit which is located in the International Financial Service Center. Now students, this particular unit, you will find the rate at which the unit is charged is at 9%. Now this is at 9%, students, whereas the normal company is at 15%. So always keep in mind this particular rate factor, the things that changes. By the way, what is the AMT rate? 18.5%. So 18.5% is the AMT rate, but here the MAT rate is at 15. The reason was this, that students, the company tax rate, you will find the next particular chapter that we will do, the alternate tax regime. There the company's minimum tax rate has become 15%. So if the normal tax rate for a company has become 15%, the MAT rate cannot be higher than 15. As the name suggests, it has to be a minimum tax. So if the normal tax has gone to 15%, you will learn in 115 BAB. So there cannot be a case where the MAT rate is higher than the minimum tax, and that is the justification why for the MAT the rate has been reduced from 18.5% to 15%, whereas for AMT the rate continues to be at 18.5%, because this 15% of the normal tax rate, that 15% of the normal tax rate is applicable only in the case of a company, not for individual or a partnership firm kind of a person. So that is the reason why AMT rate, being the minimum rate for the non-corporate SSC, continues to be at 18.5%, whereas the MAT rate applicable to a company has been reduced to 15%. But if you are a company which is situated in the unit located in the IFSC, then the rate will become 9%. Students, I have already taught you about the IFSC, International Financial Service Center, and IFSC will be subject to the rate at 9%, and in that you have seen that how the MAT calculation is to be done. So that was something which we have discussed in the IFSC topic itself. Coming to this particular part, the exceptions. Point number one, company engaged in the life insurance business, a foreign company which do not have the P, which I have already told you, a foreign company which do not require to register under the Companies Act. So all these are the exceptions on which the MAT is not imposed. So students, point number B, what it says, applicable when. What does it imply? When the MAT will be applicable. So if the income tax is calculated on the total income as computed under this act, and the income tax which is calculated is less than 15% of the book profit. So simply put, students, if your normal tax which you calculate is less than the MAT, then as we all know, you need to pay the minimum alternate tax. So that is what would be the criteria. You will have to calculate the normal tax as per the normal provision, the way we have been doing it so far, and now compare that tax with the MAT that we will be computing under 115JB. Now the question is, how do we go about it in terms of the computation? So the computation, students, will require first a base value. The base value will be the net profit as per the books, and against that particular base value we shall then do the specific adjustment of section 115JB. Specific adjustment, students, of section 115JB. You'll say, sir, which are those adjustment of 115JB? We'll see. But these would be the specific adjustment of section 115JB, which we shall do it on the base value, which is the net profit as per the books for the company. So let's have a look. A surcharge, I can just quickly run through on the surcharge part before we go to those specific cases. So students, the way we have discussed the surcharge just now, same would also be the criteria for the surcharge for the MAT. The only difference here is that there the threshold was total income, here the threshold is the book profit. That's the only difference. So that is one point that you should always keep in mind in this context. So please have a look to this criteria, same rate, students. Primarily here what you will do is that domestic company, book profit should be more than 1 crore. More than 1 crore to 10 crores, 7%. If the book profit for the domestic company goes beyond 10 crores, then it is 12%. Same way for a foreign company, same threshold. Only factor that is there, that on the MAT of 15%, you shall apply the surcharge only if the book profit will cross the same threshold that we have considered for the tax for the normal profession. So that is primarily what it would be. Now students, here 115JB subsection 1, non-applicability of the MAT. So here, supposingly, students, you are a foreign company, and being a foreign company, there is a presumptive taxation that you are applied. You are already like a shipping company or an airline company to whom the provision of section 44B or 44BBA is applicable, and you have computed already on a presumptive basis your income, and that is the only income which is assessed under the act. There are no other income which is assessable under the act. Then in that particular case, students, as per section 115JB, what we will say would be that the minimum what we shall say in this particular case would be that the foreign company, such foreign company will not be required to go the compliance of MAT. MAT is not applicable for these particular foreign company, but provided the same condition, that is only that income should be accessible under the act. There should not be any other income. If there are any other income, then definitely then they will have to get the MAT going for themselves. Now students, herein something has been written over here. Just for the time being, ignore it. All of you will only focus on this part. Please read it quickly. So students, what will happen here is this, that like for example foreign company who is having the P in India, and they are required definitely they will then be subject to MAT. Consider that students, they are having the calendar year on the basis of which they are preparing their books, calendar year. Whereas income tax law, we all know, we will have to go with the previous year. So question therefore is this, that if they are having their books prepared for the calendar year, whereas here we require the net profit as per the Companies Act, the net profit as per the Companies Act, should we now we take the calendar year, or it would still be the previous year for which the net profit needs to be adopted? It will still be the previous year, which therefore implies that these company will now have to undergo a calculation. They will then have to do a working, and that working we will all know that they will have to translate from the calendar year their profit to the previous year profit. So obviously entire thing, the policies and the standards, everything will remain the same, but they need to come out of the calendar year concept and get substituted to the previous year concept. So that is a limited engagement that they need to do in this context, and that exactly is the point. Now looking into this part, students, computation of the book profits. The computation of the book profits, let's have a look over here how the computation of the book profit shall be made in this regard. So students, over here if you see, net profit arrived in the accordance with the provisions of Schedule 3 of the Companies Act 2013. Okay, that is there. Now what we will do, students, as you can see over here, the first in this one, the book profit adjustment that we are going to do, part 1. Here first we are going to look upon the interlink. There are many interlink adjustment. There are a lot of, see what we have to do, net profit as per the books for the Companies Act, and on that net profit as per the books for the Companies Act, there is add on specified item, and then there is a less on specified item. Add on specified item, less on specified item. Now in that add and less, there are many add and less which are interlinked to each other. There are many add and less which are interlinked to each other. So what I have done is that those interlinked adjustments, I have captured them as one. So therefore now what we are going to do would be, we will be going with the interlinked adjustment first. After that, the independent adjustment, the independent add and less which are there, that would be our second thing. And finally then we will take up the advanced adjustment of 115 JB, which is to do with the Ind AS adjustment and the REIT adjustment. This would be our advanced adjustment, and once that has been done, we will thereafter switch to the practical questions. So this is the approach that we are going to follow in terms of the math chapter. So let's then begin with the interlink part. First up, students, over here. So interlink additions or the deletions. So first of all, students, I will give you a bit of philosophy. See, the concept of math was really a very beautiful concept. Initially, the philosophy on which the government has introduced this concept was indeed quite logical and quite, you can say, fair and rational. It was a very fair proposition of math. What the government was saying was this, that look, you people are distributing huge amount of dividend and you are not paying any single amount of tax, or your tax is very nominal. So now you need to take care of our interest, means the government interest. You have to take care of our interest first and then the shareholder will come. So therefore our entire focus would be that government interest will have a precedence over the shareholders interest. And that is the reason why we have selected here the net profit as per the Companies Act as the base amount. And we will see that whether this net profit is a fair net profit, or there is an attempt that has been made on the part of such companies to artificially reduce the net profit so as to finally reduce the book profit and eventually want to reduce what? Reduce the MAT liability. So any attempt to reduce this particular net profit will have the adjustments. And that was the original logic which the government had, why they are doing this adjustment on the net profit as per the Companies Act, so as to finally determine the book profit. So this was primarily the logic in which this was being introduced. But as we all know, over the years after years, there are a lot of adjustment which has got no relevance to this particular logic that I am talking about it right now. But still, it will hold us to many of the adjustment under 115 JB. Maybe at least for those adjustments, we can appreciate why that these adjustments are being carried out. Let's have a look to it one by one, students. So see here, point number 1. Add the amount transferred to the reserve, whatever name called, which is debited to the profit and loss account, other than the transfer under 33 AC or the shipping reserve. Forget the shipping reserve herein, which is not to be considered at this stage. So here, students, supposingly your profit and loss account has a debit towards the reserve account. Now that reserve may be created by any name, but by creating the reserve from the profit, you have reduced this net profit, and finally this will have an impact on the book profit, and eventually what? Eventually your MAT liability will get reduced. So therefore such attempt is captured through this particular adjustment. So what we will do, students, we will now do, I'll do first adjustment number 1 and adjustment number 2, and then let's proceed. I'll do adjustment 1 and 2 together. All of you will copy down this one. Through some small case studies, we'll try to understand the nuances of all these adjustments which are being there. Let's get started. So students, what will happen in this case? You'll prepare your profit and loss account. And then there will be what? 2 reserves. Any amount, say 10 lakhs. So net profit will get decreased. And what is the second effect? First effect is over here. Second effect will go in the balance sheet. So what they say is this, that this reserve that you have credited, you have created, that needs to be added back. So you add back the reserves of 10 lakh, and that is what will give you the book profit. Okay, so this is the adjustment. However, students, now say for example these are the year 1 adjustments. Now what will happen, students? Please pay attention. Now in the subsequent year, say year 2, this reserve may be written off. So say for example there is a write-off that is taking place of this reserve account. So say 5 lakhs has been written off. And if it has been written off, then it will come in the net profit. So the reserves which you already have adjusted in year 1 at the time when it was created, now see the same reserve is again coming to your profit and loss account on the write-off. So therefore this will lead to a double taxation. And accordingly, to avoid the double taxation, that what? The reserves which have been written off, the reserves written off primarily will be reduced, and that is how the book profit, students, that is how the book profit will be determined. That is how the book profit will be determined. So this is how you will deal with this particular proposition. This is how this will be dealt in this particular proposition. Did you all got this one? All of you? Quite logical, isn't it? We go to our next adjustment, and that is on the depreciation part. So in the depreciation category, the adjustment on depreciation. What is the adjustment on depreciation, students? So here there also can be an attempt that could be made to reduce your net profit by through an artificial means of revaluation of your fixed asset. One thing I should bring to your notice and your attention, that under the income tax law, students, under the normal provision of the income tax law, you cannot do the revaluations. You'll say, sir, how is it possible? Why you are saying so? If I only focus on the normal provision, students, normal provision, then what happens? Your entire claim of depreciation is governed by the WDV, which is as per the block. And the block as a concept freezes the moment the asset enters at a particular value. So the moment an asset enters at a particular value, that will freeze that particular block. Meaning thereby, thereafter you don't have any discretion to adjust those particular value unless there is a specific provision under the law. Like 43A, which says about the capitalization of the foreign exchange in the case of the foreign currency loan taken to acquire the foreign assets. So those situations you may have to capitalize when you will capitalize whenever you will be repaying the loan amount. That is a different context altogether. But the short point, students, to be considered over here is this, that these particular cases that we are referring right now, or these particular adjustments that we all are referring right now, majorly or primarily, students, we are into these particular adjustments, students, majorly we all are looking into the fact that the revaluation under the normal provision could not be made, but in the Companies Act, which happens to be the basis of the book profit calculation, there you can do the revaluation. And if under the Companies Act you are allowed to do the revaluation, then what will happen? If under the Companies Act you are allowed to do the revaluation, then what will happen, students? Then it will influence what? Then that will influence your net profit. You'll say, sir, how it will influence the net profit? Let's then take a case study. So here, revaluation of depreciation is the next particular slide. You can just prepare it in the next page. Revaluation of the depreciation. So if we can just quickly run through on this one. Students, there is a balance sheet. Whenever you do a revaluation, so what is the journal entry that you will pass? Fixed asset account debit. Say 100 rupees. The revaluation amount was 100 rupees. So this is the journal entry that will happen. fixed asset account debit to revaluation reserve, isn't it? Now students, what happens? So you have already done with this revaluation stuff. So now what will happen students? This fixed asset, and for which you have already done the revaluation, this will now enter your profit and loss account. The fixed asset students over here, this will enter into profit and loss account. Say for example the depreciation rate. The depreciation rate is say 10%. Assuming it is at 10%, what happens? Here we will write to depreciation at 10%, which will therefore will give us a case of 10. I'm talking only about a depreciation rate. This is the higher this 10 is what? The revaluation effect. The increased in the depreciation to the extent of 10. And that will have an impact on the net profit. That will have the impact on the net profit. And that is the reason why what they are saying is that add the depreciation effect to the extent of the revaluation portion. How much is that? So the depreciation which got increased due to the revaluation, you need to add them back. You need to add it back, and therefore 10 is what you will add finally as the depreciation on the revalued portion. That is what you will add finally, so as to determine what? Determine the book profit. Determine the book profit. So this is precisely how the book profit will get determined, isn't it? Now, here students, also just pay attention in this context. Subsequently, what will happen, students? Subsequently, what will happen would be that obviously this revaluation reserve also would get monotonous. It cannot remain perpetually at 100. They will do something or the other, isn't it? That revaluation reserve on your balance sheet, that cannot remain perpetually in your balance sheet. You need to do something or the other of this. So what you will do? You will write it off. Now the moment you write off, students, over here now, and the write off will happen in the profit and loss account. Say for example this is year number 2, and the write off that they have done, I can generally the write off would be matched with the depreciation portion of the revaluation. That is the matching concept, but still the policy may be different. They can take 50% of that or whatever it be. So supposingly their write off is like 3 independent cases, students, 8, 10 and 12. Now this is coming in your profit and loss account credit side. And what is the amount of the write-off? In the first case, the amount of write-off is 8. Second case, the amount of write-off is 10. And the third case, the amount of write-off is 12. So in that particular case, the net profit that you have determined, over here, students, on this particular net profit, what you will do? You will then add back the write-off of the revaluation reserve, because again the same logic, it will invite the double taxation. If you don't add it back, then again the same situation you will end up coming to it, and that is about the double taxation. Because already by adding the depreciation on the revalued portion, by adding it back, we have already reconciled our book profit to the normal level. We have already reconciled the book profit to the normal level. Now again, this impact of the revaluation reserve being captured in the profit and loss account credit side will invite a double taxation. And therefore, students, what will happen? This revaluation reserve, what are you going to do? You are not going to add, but you are going to reduce. So this would be reduced so as to avoid the double taxation. Now how much revaluation reserve you are going to reduce? In the first case 8, second case it is 10, and in the third case it would be how much you are going to reduce? It would be 10 only. Which is, sir, why not 12? Because only to the extent of 10 that there is a double taxation. Can you see in the previous scenario, the to depreciation at 10% was 10. So only to the extent of 10 that there is a double taxation, and that is what the entire objective is. So this is how you will determine your book profit, and on this here you will calculate your MAT. So these are the small calculations, students. You have to be very careful about it. We will do a consolidated adjustment practical problems later on, but right now, adjustment by adjustment of each entry. Let's see what it has to say. So this is all over. Through with this one, students. Now I'm going to the next particular slide. If you all are done with this, coming back to our point number 3, students, DTA and DTL provision. Point number 3, DTA and DTL provision. Obviously, DTA and DTL provision will have no place whatsoever. DTA and DTL provision will have no place whatsoever so far as the book profit is concerned, because obviously this deferred tax asset is a function of what? Function of the books tax versus the tax as per the income tax law. Now we are yet to determine the tax as per the MAT provision because we are calculating it. So any such sort of a provisioning made earlier in the books in respect of DTA and DTL will have to be added back, because these are notional income which has something is not the correct tax provision, which can only be determined once the MAT amount is actually determined. Therefore, those provision needs to be added. This point number 4 and 5, students, is the game. It's a real thing, and you will learn the real nuances of the book profit calculation, but that I'll do it in the part 2. First, initially we'll just deal with the simple areas. Now, point number 6, expenditure related to the income. So the exempt income, students, will not form part of the book profit. Similarly, any corresponding expenditure in relation to the exempt income also will not form part of the book profit. This is what they are trying to suggest through this particular adjustment. Again, I'm repeating, adjustment in relation to the exempt income do not form part of the book profit. Similarly, any expenditure which is in relation to the exempt income will also not form part of the book profit. Now, why is it so? See, students, I told you the government does not have any issues if you actually get an exemption, and that is the reason why your total income has been reduced. Because see, whatever is within the range of a commoner, a common public, like I am claiming an exemption of 10(1), you are also claiming the exemption of 10(1), everyone. So this is within the striking distance of everyone, every citizen, every taxpayer. The exemptions of section 10(10) is within the striking distance of all the taxpayers. But when it comes to provisions like 10AA, 80IA, 80IB, 35AD, now that creates that level of the disparity. Nobody can engage themselves into this activity. Only the big corporate house or the HNI are the one who can indulge into these kind of a high business model, high capital intensive model, and generate a huge amount of profit and eventually pay no amount of tax as per the normal provision. So the government understands this factor. They say that, look, what is otherwise available to all, if you are also availing that benefit, we don't have any issue. So exempt income and the corresponding exempt expenditure, the expenditure on such exempt income, and the corresponding expenditure on such exempt income, they will not form part of the book profit. They will not form part of the book profit. And that is exactly what this particular point number 6 is all about. So this is all about student section number 10. Now there is one particular point which is very interesting. That is about, here it has been referred as the section 10 exemptions. Section 10 exemption will not form part of your book profit. Neither the income nor the expenditure in relation to such income. The question, students, over here is that, what about the 54 series exemption? So if there is a 54 series exemption, 54 series, 54 EC and all, whether they will form part of, so that income on which you, long-term capital gain for example, on which you have made certain investment, against which you have made certain investment. So whether those because of that investment, they are eligible for that 54 EC exemption under the normal provision. So the question that comes to you is this, that whether that exemption of 54 EC, will that be extended in computing the book profit over here? Will that be extended in computing the book profit over here, students, is the question. So here there is one judgment, students, of metal chrome case, wherein the Madras High Court has held this case law. By the way, I should tell you, students, it is reported by the ICA also. And please, I will request to all of you to just go through my case law lectures, which are for May 21, November 21. 66 case law I have prepared. Around 66 to 70 case laws. That is a list. PDF file is also there. So my request to all of you would be just to go through those case laws, and I have shared also. It is already, in fact, was there in the Unacademy YouTube channel itself, and I've shared in all your groups and everywhere I have shared it. Please go through them, because that is a very important one. In that 2 hours time, I have completed all this quick revision of these case laws. Do let me know if you don't have that particular case law link with you. So students, in this context, in this particular context, what I was just saying, that the Madras High Court said that yes, that particular income on which you have made the investment to claim the exemption to 54 series under the normal provision, these income will not form part of the book profit. They will not form part of the book profit, students. Now, what is that unique thing that they've picked up? My request to all of you would be to go through that particular judgment. I'll just let you know. They said that this provision of 115JB suggests that all the other provision of the Act will apply. So therefore, in that case, if as per the other provision where the assessee has undertaken a particular action for which he is eligible for the exemption, then the same should also be made applicable for the purpose of computing the book profit of that particular assessee. And hence, going by that particular reason, the Madras High Court, to me it is a controversial decision, students, but still I will say to you that go through that particular judgment, because that could be one of the important judgment for your examination purpose. Although it's a Madras High Court judgment appealed before the Supreme Court, the matter can get overruled. But since the ICA has covered that case law in their materials, and it has been recently covered, so please go through them. And the answer is that 54 series exemption, the exemption under 54 series will be because of 54 series exemption, that portion of the capital gains, will not form part of the book profit. They will also not form part of the book profit. So that is one point which I just thought of it to just take you through towards this point. So just take a note of this one. I'm putting an asterisk over here and take it down. Similarly, long-term capital gains, which is eligible for I've written 54 series shall also not in the bracket Madras High Court. This is only Madras High Court, I'm just writing it. And the analysis I've already done it, those particular cases. Just all of you just go through it once, that case law segment. With this, now we go to our next interlinked additions and deductions, and that is point number 7, students. What it says, add the expenditure relatable to the income being the share of income of SSC from the AOP or the BOI on which no tax is payable as per section 86. So students, what is the background of this particular adjustment? Please pay attention. Just take a situation where I am a partner in I'm a company which is a partner in a partnership firm. Okay. I receive the share of profit from the partnership firm. As we all know, a share of profit received by the partner of a partnership firm, that qualifies for an exemption under section 10(2)(a). So in that very case, I will be eligible for the exemption under section 10(2)(a) in respect of the share of profit which I am receiving from that partnership firm. By the way, who am I? I am a company. This is case study number 1, situation number 1. Let's take situation number 2. I means a company is the member of the AOP. Now, if a company is a member of an AOP, students, the AOP is taxed at MMR. And if the AOP is taxed at MMR, then the share of profit, primarily share of profit received by the member from the AOP, will not form part of the total income. That is as per section 86. The share of profit received by the members from the AOP, where the AOP is charged at MMR, that share of profit will not form part of the total income. Now this is a reference given in section 86. Just now I told you that the share of profit received by the partnership, received by the partner from the partnership firm, that is exempt in their hands under section 10(2)(a). The fact that they got a shelter of section 10, that they were in a position to do what, students? They were in a position to exclude those particular income in computing the book profit. But then the same thing when it comes to the member of the AOP, where the AOP was taxed at MMR and the income received by the member is not to be considered in the total income. Unfortunately, because it was under 86, this was under the danger of being subject to MAT. And therefore, in order to bring the things in congruence, both the situation at par, which situation where you are a partner in a partnership firm versus where you are a member, where you are what? You are the member in the AOP. So to bring both the situation at par, that students, that they have given what? That they have given this particular part. And you will find that both the income as well as its corresponding expenditure, they will not form part of the book profit. Both the income as well as the expenditure, they will not form part of the book profit, is what you will have it over here. So you can just also put across the star. I'm just putting it and making you write a note over here. The entry for section 86 is to bring the situation at par in case of where the company is a partner in a partnership firm as compared to where a company is a member of the AOP. In the bracket you can write and the AOP is taxed at MMR. The AOP is taxed at MMR. Okay, students. So the entry for section 86 is to bring the situation at par in case of where the company is a partner in a partnership firm as compared to where a company is a member of the AOP in the bracket and the AOP is taxed at MMR. Fine. So this is what you will look into it in terms of the section. Now we come to the next particular point number 8. Students, this point number 8 I have already touched upon while we were discussing about the taxability of the royalty income. At the point of the time of taxability of royalty income for both non-resident as well as resident, this opportunity came wherein we discussed this 115 BBF, the royalty income earned by a resident who is the first and the true inventor of that patent. Then that particular royalty income would be charged to tax under the normal provision at a gross basis, at a gross rate of 10%. That royalty income would be charged to tax in the hands of whom? In the hands of whom, students? In the hands of the resident as per the normal provision at the rate of 10% on gross basis. There itself it was being mentioned that this royalty income will not form part of the book profit. This royalty income will not form part of the book profit, and accordingly, students, we will say that this particular 115 BBF, both the income as well as the expenditure, as the case may be, shall not form part of the book profit. Shall not form part of the book profit, and that is exactly what this point number 8 is all about. Now, point number 9, students. Add the expenditure of foreign company relating to what? Capital gains arising on transaction in securities, or the interest, royalty or fees for technical services chargeable to tax at the rate specified under 115A to 115BB if such income is taxable under the general provision of the Act at a rate of less than 15%. So students, be very careful. What happened, I will tell you the background of this. This was majorly to appease the foreign institutional investor, but now it is applicable to all the foreign company. So what happened for them, students, was that on one hand you talk about I'm just giving an example. On one hand you are talking about 115A, where the rate of say royalty is say 10%. Interest, you remember that 194 LC? Interest, that rupee denominated bond and all, 5% was the rate of the interest. The tax rate for the interest was 5%. Royalty was at 10%. Then thereafter there is 112A where the rate is 10%. So what these multinational companies said was that on one hand you are saying it is 5% and 10% and 10%. And then on the other hand you are saying that no, foreign company, the fact that you have to maintain the books of accounts in India, you will be charged to the rate of, to what rate? To this particular rate of 15%. So therefore, effectively we know that provision which you actually showcased to us and tempted us to make the investment in India was simply an eyewash. Your real color is found in 115 JB, wherein you would be taking at least 15% as the MAT from us. And then the government will say, but then you will take a MAT credit. There is a MAT credit the way we were discussing about AMT credit. Then what the associate will say, then when the MAT credit, just like the AMT credit, if at all it has to be utilized, you need to have the tax as per the normal provision. And the fact that our income would be taxed at 10% or 5% as the case may be, we will never have a tax as per the normal provision. We will always have a tax as per the MAT. And therefore, India doesn't become a good lucrative destination for us for our investment. The government took the cognizance of this fact, and accordingly for these foreign company, if they have the income, if they have any income which is getting charged to tax at a rate which is less than 15% as per the normal provision, then those income will not form part of the book profit. Those income will not form part of the book profit is what is the provision as far as this point is concerned. So students, if you can just have a look to point number 9 again, what it says, point number 9, add and less both. Please read both add and less, all of you, point number 9. Fine, students. Now, can you see in this point number 10, which is about index adjustment? I told you index adjustment in the next part. A very important adjustment of index, which we'll do on the next part. Now, please come to students, add to this the independent additions. The independent additions. What are the independent additions, students, that you will have to make? So, here the independent additions are the provision for unascertained liability. Now, be mindful of the fact that under the head PGBP also, the contingent liabilities, if the same you have provided for, then that will also be disallowed. Similarly, there can also be the attempt to reduce the book profit, to reduce the net profit, and eventually the book profit by creating a debit which is in relation to what, students? To an contingent liability or an unascertained liability, and that is the reason why such attempt is sought to be addressed by requiring an add back in computing the book profit. Similarly, students, if you see point number 2, the provision for the losses of the subsidiary company. Now, as far as the subsidiary company, students, one thing you should know, that under the income tax law, the loss which is incurred by the person or the loss which is suffered by the person, only that person will be the one who would be allowed to carry forward the loss for the purpose of set off. So here, if there is a holding company, then as per the income tax general principle, whether the holding company can carry over the loss of the subsidiary company or can they provide for the loss that they had it in the subsidiary company, and the answer is no. So that is the reason why this, again, the same provision is not adjustable. They are not deductible either under the normal provision or under the income tax law, isn't it? The one who has incurred the loss is the one who will only will try to take the benefit of the set off, okay, and not the any other person. Yes, there are certain exceptions which is there, like for example 72A. There are certain exceptions that we have seen: amalgamation, demerger, succession, conversion, etc. But that were the specific provisions which created those level of an exceptions. Beyond that, we are not supposed to take that into account. Now see the next one, students. Income tax paid or payable. Please have a look. Read this point number 3 very carefully. So can you just have a look here? Income tax includes, so they have included further in that the DDT. Interest under this act. Now, interest under this act, students, can be of anything. Now, when it comes to an interest under this act, this interest under the act can be anything. Like, for example, the interest for the TDS, TCS, 234 ABC. It can be any interest. 220 interest. So any interest which is charged under the Act will form a part of the income tax and accordingly will not be allowed. Surcharge and HEC again will be considered as a part of an income tax and therefore will not be allowed. What about the penalty, students? The penalties and all, if that is debited in the profit and loss account, so students, if it is debited under the profit and loss account, then as per the normal provision, it may be added back. As per the normal provision, it may be added back. But when it comes to the computation of 115JB, then these same penalties will not be added back. Which is, sir, why is it so? It should have been added back. So if it is to be added back, then why don't you also add back the cash disallowances, 40A3? Even that should be then added back. Then there is no end. Why don't you then add back the TDS disallowances? TDS default and then the disallowance. So kindly add back to the book profit also. Why don't you add back that 43B if you have not made the actual payment of bonus and commission to the employees? Why don't you then make another total income at all? Then you make another total income. Why you are so entertaining the book profit as a concept? Make another total income. Do all what you have done there and do it over here again. So the short point, students, is that why you are not supposed to do. Please understand this. See, we are not. These are the infraction you have done it. The government primarily, when they considered the MAT as a concept, the government was only attacking on the fact that, like, before the shareholder, we should be there. We should be there. That was their only objective. Before the shareholder, we should be the one who should be served. That was the objective why they have came up with the MAT. Now, if in the meantime there are certain like cash payments and all, or the penalties that would have been charged in the process, that is fine. That is not primarily for what we have introduced the MAT for, that we have to compute the total income. All these adjustments that we are witnessing so far has that underlying message. Whatever that we have seen or whatever we have felt so far was giving that underlying message that, look, you are taking extra incentives, plus you also are rewarding the shareholder, plus there are some attempt made on your part to artificially reduce your net profit. These are the factors that we are considering so as to determine the book profit. Now, whether the penalty is imposed and that is debited, whether the payment was made in cash, which is also debited, whether the TDS defaults have been done, all these are not something a kind of the issues or concerns for the book profit computation. These are the matters of concern when you compute the total income. So don't create in this exercise of 115JB another total income concept. You're not supposed to do that. In fact, students, if you find it, there is one table which I have prepared for you, which is such a great table that can you see comparison of all the adjustment of PGP and MAT. All the adjustment, you should go through this particular table very carefully. It gives you those comparison of what you do it in PGP and what we do it over here. Only there is a limited commonality, like for example, provision for uncertain liability, provision for the losses of the subsidiary company, and then even the income tax. So these are the limited common feature that you will find at both the places. But then you will always find an overwhelming adjustment which are there for PGBP and very limited adjustments are there for 115JB. And the limited adjustment which is there for 115JB has its own logical explanation, which is the fact that it is only limited to the fact that the government want its interest to be secured before rewarding the shareholders. And in doing so, if there can be some attempt on the part of the SSC to artificially reduce the net profit and eventually the book profit, then through this particular attempt, they are trying to ensure that the SSC is not successful in doing so. So that is the limited logic on the basis of which that the MAT adjustments are being made. And as I told you, there may be overlapping, but only to a limited extent. Students, only one part which I think just want you all to just consider this. All the things are fine. 54 series. Can you see that 54 series? Less. And that is as per the Madras High Court judgment. The controversial judgment covered by the ICI. Just in the PDF which would be there in the description box, I would have already have corrected that thing. Okay, so just keep that in mind. Now with that, students, you all are through with this. Coming back, please come back to this particular part. Dividend paid or proposed. Again, obviously, our interest has to be prior to the dividend. So if supposing the dividend has been debited in the profit and loss account and the net profit has been reduced, so obviously the net profit has to be inflated with these dividend which have been paid or proposed, isn't it? Because the government is before the shareholder. Provision for diminution in the valuation of the asset. Now see, these are what I was talking about it. This is not something which is supporting the underlying philosophy on the basis of which the MAT was being introduced. These sort of deliberate adjustments that the government have done, they never have supported. They have never have supported the underlying logic which was there on the basis of which the MAT was being introduced. So provision for diminution in the valuation of the asset, students. An example which can be given is like, simple example, provision for bad debts. Provision for bad debts. So if there is a provision for bad debts, please add it back. So that is what it is. So there is a code to remember. You can just use this code of all the additions, mnemonics. You are using the mnemonics of all the additions that is required to be done. Now please see the less part, independent deletions. So what are the independent deletions that you will have to take into account? Here you go. Profit from the sick industrial company, students. So at least they have shown some mercy that this profit till the time you are sick. Students, till the time you are considered to be a sick entity, you on the profit of the sick entity, we will not be charging any MAT. So till the time you are a sick entity, that profit will not form part of the book profit. As simple as that. That profit will not form part of the book profit. And therefore, if you see profit from sick industrial company from assessment year in which company was declared sick till assessment year in which net worth is minimum of the or minimum greater than or equal to the accumulated loss. So the moment the net worth goes beyond the accumulated loss, you will no longer be considered as the sick unit. Your net worth should go beyond or should be in excess of the accumulated loss. Only then you will not be considered as the sick company. So this period, can you see this period from AY in which the company was declared sick till the AY in which the net worth is exceeding the accumulated loss. So from this period to this period, whatever is the profit from the sick industrial company, that portion of the profit will not form part of the book profit. That portion of the profit, students, will not form part of the book profit. Did you go this far? So that is the less that you will have to do. Then point number 2, if you see brought forward loss or unabsorbed depreciation, again as per book. Now this is the point. Please pay attention over here. So the company says that fine, you have the objection that before dividend we should take your interest into account. Before dividend that we will pay to the shareholder, we should take your interest into account. The company brought to the attention of the government that before the dividend is paid, before what? The dividend is paid, as per the Companies Act, we are supposed to adjust what? The unabsorbed depreciations, the brought forward losses, as per the books only, So those needs to be provided for, and only after that we are supposed to distribute the dividend. So if that is the case, at least then we should be eligible for what? Reducing these brought forward loss and the unabsorbed depreciations in computing our book profit, because that is what we do before we distribute the dividend. So that is what we do before we distribute the dividend. So even this same privilege we should be given over here in computing our book profit, and finally whatever is the book profit that would be determined, on that we will pay you the MAT. The government agreed. They said, understood, yeah, that yes, that is what you all do, and that is the requirement of the law, that before dividend this is what happens. So if before dividend, if this is what happens, then definitely that can be adjusted in computing the book profit. But the government played a game, students. And what is the game that the government played? They allowed the deduction, but only in respect of one. What they have said, that between the two you have to choose one. That is either the brought forward loss or the unabsorbed depreciation as per the books, whichever is less. Between the two, choose only one, is what the government is suggesting in this case. And that is what is something has completely taken the SSE aback. So students, this is precisely what it is. Not both, but primarily only one. Now just please recall in the normal provision what we do. What we do in the normal provision, students? In the normal provision, we take the deduction of both. But yes, there is a hierarchy. And as per the hierarchy, we first reduce the unabsorbed depreciation. We reduce the brought forward business loss, and thereafter we reduce the UAD. That is the hierarchy that we follow for the purpose of the deduction or the set off. Here what we are doing is that here we have to either choose between the two. And what is the amount? That would be as per the books, not as per the income tax law. Again, that is the point. And finally, whichever is less is what you are going to reduce. Whichever is less is what you are going to reduce. Now, so therefore, students, here if you see what happens, if one of the two becomes loss, if one of the two is nil, if one of the two will become nil, automatically what happens? Automatically we will say that the set off will be of zero amount, because then the nil is lower of the two amount. So therefore in that case the set off would be of the nil amount. And the last but not the least, students, is that profit from the tonnage tax scheme. So tonnage tax, just like the way we've discussed about it, 44B, 44BB, 44BBA. So same way here also for the tonnage tax. Primarily again, this will not form part of the book profit. So good for the shipping company, domestic shipping company, who has opted for the tonnage tax scheme as the basis of determining their income under the head PGBP, and thereafter the tax liability would be calculated on that. On these shipping companies, their profit will not be forming a part of the book profit. Now students, the government in fact took a cognizance of this particular point through one important amendment. Which point I'm talking about? Point number 2. They said that look, we will give you the deduction in respect of both, meaning thereby the depreciation as per the books as well as the brought forward business loss as per the books. We shall be giving the deduction in respect of the both if what? If one of the two would have happened. And what is that one of the two that we are talking about it? From point number A, if you can have a look over here, friends, that the company primarily and its subsidiary and subsidiary of such subsidiary, whether tribunal, just take into account this section 241. You will have to see in the examination 241 company. Okay. So herein and in the 241 company is that where the central government they have suspended all the board, and they have appointed their IS officers into this board of directors. So for that kind of a company, both the unabsorbed depreciation and the business loss, brought forward business loss as per the books, will be allowed to be adjusted. And the second one, students, that you can see is the the insolvency and bankruptcy code. If the company has already filed for the IBC, then both the unabsorbed depreciation and the brought forward business loss as per the books, but again I'm repeating students, as per the books, both of them will be allowed as deduction, okay, in computing the book profit. So that is what it is. So we are just given a small example about the fact that you can just go through it, self-explanatory, so nothing so great about this. Okay, just go through it once. So that students, now in the next particular part, I'm going to do with all of you, the provision in relation to the Ind AS and the REIT. Once that is done, finally then we'll switch over to the practicals, and then that should be all so far as the matter is concerned. So now one session would be only specifically for Ind AS and the REIT, and then thereafter the separate session for a practical case studies. See you then, students. Just go and revise quickly, students, this particular part, and I'll see you in the next part, next segment.